We can see with all of these companies, including IBM today announcing a $150 billion five-year capital investment commitment, which comes after a collective, literally hundreds of billions of dollars. We're going to see trillions of dollars invested in AI and data center and IT and data center infrastructure over the next several years. This is going to be a powerful economic growth driver.
It's interesting when you bring up IBM. IBM's actually a winner this year, which is not, last year I can't even count probably on one hand the amount of times we talked about IBM, and it's outperforming all of the Mag 7 this year. How are you thinking about market leadership as we start to think about, the next few months of the year into year end? Do you expect overall tech to start to lead this market again, or is it going to be much more of an individual stock kind of story?
Well, I think the tech sector will continue to lead the market higher. And collectively, it is companies like Nvidia. And Nvidia has, nobody is going to catch Nvidia. Every time somebody else, whether it's Huawei, AMD, anybody else comes up with their newest GPU, Nvidia is already way ahead. They have the Blackwell Ultra coming out in the second half of this year. They got a new processor coming out in 26 and 27. They are so far ahead of everybody else. And for the most important inferences and AI platforms and applications, you're going to want to run the fastest and best chip because that gives everybody their competitive advantage. Remember, all these companies are competing on this AI front, and they're not going to cut costs because cutting costs could risk their leadership or position or competitive advantage. And it's not like they don't have the resources to spend. So it really is an arms race of who can spend the most to drive the fastest and best platform and drive this whole AI investment wave forward.
The tech firm Nvidia is well known for its superior GPUs and AI systems. Data center GPUs, such as the H100 and Blackwell chips, which are crucial parts of AI workloads, are its main source of income. The business is well positioned to take on massive industries such as the $50 trillion robotics market, the $500 billion enterprise AI sector, and the $1 trillion plus AI market. With the delivery of the GB200 series and expanded testing capacity for more intricate GPU racks, Mizuho analysts are upbeat about Nvidia's short-term prospects. Nvidia's long-term capital investment in AI till 2026 was also emphasized by the experts as a crucial factor for potential investors. With a price objective of $168, Mizuho Securities kept its outperform rating on the company in spite of recent U.S. export restrictions that impact shipments of its H20 series products to China and other embargoed nations. About $5.5 billion in revenue from an anticipated $16 billion in H20 orders could be impacted by these restrictions. Nvidia's strong position in the AI processor business has Guinness Global Innovators extremely optimistic about the company. In their investor letter for the fourth quarter of 2024, it said, Nvidia was the fund's best-performing investment for a second consecutive year, with an impressive return of plus 177.7%. Since the start of the previous year, Nvidia's Hopper GPUs have been at the forefront of the rapidly growing need for processors that are strong and effective enough to support the energy-intensive needs of AI processes in data centers. With a 95% market share in these chips at first, Nvidia has quickly solidified its position as the industry leader in technology. In March, it introduced Blackwell, the successor to the current Hopper GPU, which prevented companies like AMD and Intel from making significant inroads into the rapidly expanding market. The Blackwell processor is twice as powerful for training AI models and has 5 times the capabilities when it comes to inferring the speed at which AI models react to queries as compared to the previous generation, Hopper, which is still driving Nvidia's extraordinary revenue growth. Nvidia's financial performance has held up well throughout the course of the year. In their most recent quarter, quarterly revenues reached $35.1 billion, which was a plus 94% year-over-year gain and 6% higher than the consensus estimate. Furthermore, the Hopper, H100 chip-driven NVIDIA data center segment increased 5-fold in the last 12 months, highlighting the ongoing need for cutting-edge AI infrastructure. The H100 chip, which costs about $40,000, is still widely used because it can increase the effectiveness of AI model training while reducing expenses overall. Nvidia is in a strong position to take a sizable chunk of the projected $2 trillion market opportunity over the next 5 years, and this growth is anticipated to continue as businesses spend in modernizing and constructing new data centers. Although there have been some worries that Blackwell production delays have caused share price volatility, Nvidia has quickly recovered thanks to the company's strong earnings results this year and management's promises about future supply. Furthermore, Nvidia's technological leadership is expected to be extended with the release of the H200 chip, guaranteeing sustained progress through 2025. Nvidia's valuation is still up for dispute, but considering its dominant market position, inventive capabilities, and exposure to long-term secular growth patterns in AI, cloud computing, and data infrastructure, the stock still seems reasonable and is not at a substantial premium to history. Because of this, Nvidia is still in a strong position to provide consistent long-term outperformance, which makes it a vital component of growth-oriented portfolios. So, what implications does this have for Nvidia's stock? Let's explore that. But first, a big thank you to those of you who've stuck with us this far. Creating these videos takes significant effort and dedication, so if you're enjoying the content, please hit the like button, subscribe to our channel, and share your thoughts on Nvidia stock in the comments. Your support truly helps us grow. Now, let's get back to the video.
Our colleague yesterday, actually, about the U.S. lead over China in terms of technological advancements, and then this threat of Huawei potentially for Nvidia specifically. How much of a threat do you think China is right now in terms of our lead for, in terms of the U.S.'s lead for AI?
Very much a threat. I would say that in some areas, they actually have advantages. You could argue that the way their political system works in concert with business is an advantage that they will continue to exploit. I would say never, ever, ever underestimate them. Don't relegate China to a place that simply steals intellectual property. That is not the case anymore. I'm sure there's a fair amount of that, but they absolutely are leading in innovation in certain areas. So it's going to be a clash of two titans. We're in the midst of a Cold War associated with AI. Hopefully, the result of that is that we all get better because of that competition. No one can sit back and rest on their laurels.
Only a few years ago, China accounted for a larger portion of Nvidia's income than the US. However, as the artificial intelligence AI boom gained momentum, the United States began to expand as a major source of growth for chip designers. The best graphics processing units, GPUs, and other products and services from Nvidia were sought after by US tech giants like Amazon and Meta Platforms, who increased their AI platforms. Consequently, Nvidia's overall revenue skyrocketed, increasing in the double and triple digits every quarter to hit all-time highs. And China's role in that picture was getting smaller and smaller. According to a geographic analysis, Nvidia's revenue from China decreased from 26% of total sales just 2 years prior to just 16% of overall sales in the fiscal 2024 year. Additionally, U.S. revenue increased from 16% of total sales to 44% throughout same time. However, the rise in U.S. spending on AI infrastructure was not the only factor contributing to this trend. The U.S. government's 2022 decision to restrict the export of potent AI tools to China also contributed to this. Additionally, Nvidia's prospects in China have been under increasing strain lately. Nvidia was notified by the United States this month that it could no longer export the chip it had specifically created for China to that nation. Even worse, it's possible that Huawei, a major rival in China, is developing a new processor to compete with Nvidia there. Do investors need to be concerned about Nvidia's prospects in China? Let's investigate. First, it's crucial to keep in mind that, despite the fact that export restrictions imposed by the government have undoubtedly hampered Nvidia's expansion in China in recent years, the company's operations in the United States and even other nations have flourished. Therefore, despite not having a big lift from the Chinese market, Nvidia has produced notable growth. Massive U.S. technology companies waited in line to order Nvidia's high-performing GPUs, or AI chips required for activities like the training and inferencing of massive language models as the AI boom gained momentum. Even though Nvidia doesn't reveal its largest clientele, many investors have come to the following conclusion based on analyst reports and tech companies' remarks regarding AI investment. Microsoft, Amazon, Meta, and a few other major tech companies are probably among Nvidia's largest clients. All of this indicates that Nvidia's recent expansion has been significantly fueled by investment outside of the United States. To stay informed about the latest developments from Nvidia and the ever-changing stock market, consider subscribing to our investing tutorial channel. We provide daily updates on significant market shifts and key catalysts, so hit that subscribe button to ensure you never miss crucial information. We'd love to hear your thoughts on Nvidia stock, so please share your opinions in the comments below. Now, let's dive into today's video.
We know the state of the AI trade actually holding up pretty well today, and April has been a pretty good month for tech. Not so much in terms of year-to-date numbers here, but I'm curious. We know the AI trade has been under pressure. Has anything changed about the AI story, this AI revolution?
I don't think anything has changed in terms of the real story. The real revolution will continue for years. We're at the very, very beginning stages. It's just that the closer you get to any individual company that's involved or any individual technology, the more chaotic it will appear. So co-opetition is the name of the game in this battle as folks cooperate and compete with one another moving forward. And that's going to yield lots of chaos the closer you get to the situation.
Co-opetition, I like that. That's a new one for me. I just wrote it down, and spell check doesn't know that one either. But obviously we have 4 of the Mag 7 reporting this week. We'll continue to hear from tech names throughout the next month plus. What are you expecting to learn this earnings season, especially from some of these tech companies, as it relates to the AI narrative?
So I really am looking at some of the things. Great example is what Meta is doing around LlamaCon, their user conference, where they're seeking to take something that you could argue is a product or a feature of their platform and create more of an ecosystem around it. So I'm really digging in under the covers to see how Google and Apple and Amazon and Meta et al. Are seeking to create their own walled gardens, sometimes gardens without walls, but walled gardens nonetheless, to deliver the kind of user experiences that we will demand moving forward. Right now, the big hurdle to overcome is managing our private data in a way that allows us to have these virtual assistants that can behave like a virtual assistant.
So LlamaCon is Meta's basically first AI developer conference. I believe it's going on right now, actually.
Yeah.
So we'll be sure to look for headlines from that. In terms of what we could hear from Meta and some of its competitors or other Mag 7 members that haven't been performing so magnificently this year, what is the impact of tariffs? Obviously, for a company like Apple, it's much more clear, right? Because it's a product that could be coming from China, that could be have tariffs slapped on it. But for names like Meta or Microsoft or some of the others that don't have clear products coming from a place, what could the tariff impact be?
Tariffs, not a good thing from any perspective. And the issue right now is the uncertainty. So that uncertainty does not help the prospects for results. Even if you don't have a direct-to-consumer product like Apple does, your cost structure is massively affected, especially when you're consuming anything that's coming out of China, just to be blunt. So I think that everyone is hoping for a resolution, kind of sane agreements to be hammered out over the next 90 days. It's really impossible to predict what's going to happen. I'm hopeful that we'll get to a place where earnings won't be affected as much by the whims of tariffs, but instead we can look at business fundamentals moving forward. The kinds of things like, how much is a Google or a Microsoft, an Alphabet or a Microsoft, transitioning from Nvidia infrastructure to their own bespoke infrastructure. Those are really interesting conversations to have because, again, co-opetition, they affect a lot of players in this space.
True. We talked to your colleague.
Let's now examine the difficulties Nvidia encounters in China. As previously stated, Nvidia was recently informed by the United States that it would require a special license in order to sell chips to China. even if those chips were properly built and compliant with export regulations. No company has been offered such permits by the US to date. In the meantime, rival Huawei may be taking advantage of this opportunity to increase its market share in its native nation. According to a Wall Street Journal, the Chinese chip manufacturer is scheduled to test a new AI chip next month. The chip could compete with Nvidia's most potent chip, the H100. Nvidia may find it extremely difficult to re-enter the Chinese market if this is effective, because the United States forbids the business from exporting high-performance processors there, and local consumers might not want a lower-power CPU if they can obtain top performance from Huawei. Nvidia might not be done with China just yet. According to WCCF Tech, the Digitimes stated that Nvidia might be thinking about starting a different company in China. Regardless of the veracity of this, it is evident that Nvidia's astute CEO, Jensen Huang, may be considering a number of alternatives that would enable Nvidia to continue operating at least somewhat in the nation. However, investors shouldn't anticipate that China will be a significant growth market for Nvidia anytime soon. Should investors be concerned about this position then? Naturally, Nvidia is not happy about this virtual barrier in front of the Chinese border. However, it also doesn't mark the end of Nvidia's explosive growth trajectory. The company has profited from expansion in the United States, as we have seen in recent years, and its decision to increase domestic chip production may help this. Over the next 4 years, Nvidia plans to build up to $500 billion worth of AI infrastructure in the United States. It's crucial to keep in mind that the development of AI infrastructure is far from finished, and big firms like Alphabet have recently discussed their ambitious expenditure plans and named Nvidia as a major partner. All of this suggests that Nvidia may be in for a challenging time in China. In the worst case, if Nvidia is unable to sell its chips in China, Huawei might even surpass it there. Nvidia is a great investment for investors in the long-term AI story because, even in that scenario, the company's operations elsewhere are still robust enough to propel massive growth over time. Don't forget to share your thoughts and experiences in the comments below. Your input helps create a more knowledgeable community where we can all learn and grow together in the world of investing. Stay up to date with the latest market trends, insights, and key updates by subscribing to Investing Tutorial. We're here to help you make smarter investment decisions and stay ahead of the curve.
Kevin, let's talk about options flows in the S&P 500, and then we'll talk about some of the levels you're watching. Fill us in.
Yeah, I mean, obviously, you're seeing another decent day to the upside here, up about 0.6% on the S&P 500. You did see a fair amount of bullish activity happening once we had the Lucknick interview on CNBC earlier. That's really where you started seeing a nice little push to the upside here. Now we're hitting a range or a level here around 55.70. That's going to be your first area of major resistance here for today. But there is a possibility that we could try to attempt the 5600 level. It just kind of depends on that market on close and balance order. That we'll get here in about 17 minutes or so. But overall, this has obviously been really good positioning. To the downside, if we have any type of failure after we have this kind of channel that's been developed here, to the downside, looking at around 55.25. Overall, Caroline, the flows have been looking, for the most part, fairly bullish for the market. But I think if you kind of look at a little bit of a longer time frame, there's just some items to kind of keep on the radar here. But for today, so far, we continue to see some strong action here. It's been a little bit more of a range-bound market when you're kind of looking at the intraday trading, where support levels and resistance levels have been holding up very well. So if you're an intraday trader, this is kind of the environment that you really thrive on, especially with the VIX that's still sitting at around 23 to 25. So overall, this is actually looking pretty decent. If we do have a little bit of a pushback, the first area, 55.45 for the S&P 500 going into the close, and any failure below that, once again, 55.25 is what I got on my radar here.
Okay, what about to the upside, Kev?
Yeah, to the upside, just for the intraday, once again, 55.70 is going to be your first area, and then you could look at around 5600. It is definitely possible for that we actually can hit that for today. And if we actually do, Caroline, just to kind of like expand this out, it becomes a major short zone for this market. So I would just kind of be a little bit cautious. If we look at the E-mini S&P 4-year weekly chart, the reason why I kind of bring this up, we actually have, and we've been looking at this for the last couple of weeks, some anchored volume weighted average price levels here. Now, this is just basically taking the overall volume, those prices, and then it makes a moving average, if you will. And you can see that we were able to hold that moving average, or the anchored VWAP that we call it, on the October 2022 lows. That was pretty much the low that we've seen in this, let's call it maybe minor bear market pullback here. But I also have an anchored VWAP from the February 2025 highs here. And that has been an area of resistance ever since that we hit those highs. Every time that we've touched it, we've rejected it. And for the E-mini S&P 500, we're pretty much right there. It's sitting at around 56.22 right now. So you're sitting at around another 40 points to the upside, where we might actually see some sellers actually getting into this market, because it's going to be a fairly a key area of resistance. The other reason why I kind of bring this up, you're seeing some actual interesting kind of dynamics when you're looking at the internals for the marketplace here. The first one that I really kind of focus on is that 10-year 3-month spread, that treasury spread. And what we've actually seen over the last 3 to 4 trading sessions here is that spread is starting to actually get inverted again. And we are actually in an inversion once again. And this has not really been the trend with equity markets moving higher. We've actually like to see that spread moving wider, or basically moving higher. And we're not really seeing that right now. That's something that's a little bit on my radar as a little bit of a cause for concern. Do we start getting back into the bad news is actually good for equities because of the anticipation of Fed rate cuts, which is kind of a dangerous little game that we're playing, and just kind of seeing what the yield market's doing right now compared to where we are seeing the E-mini S&P 500 coming up to resistance. I would just be very cautious about the extended move to the upside here. Maybe a pullback might be on the horizon over the next couple of trading sessions, but this is something that has been just kind of hit my radar here today that wanted to bring up for our viewers.
Yeah, no, certainly interesting there. And, we've gotten used to some volatility, so I don't think that would be any huge surprise. Anything else on your radar, Kev? We've got, 24 minutes before the close.
Yeah, so let me just kind of expand on this. So the 10-year 3-month spread is in an inversion, or it's negative right now. That's something that you really don't want to see for a sustained bull market. The other factor here is the high yield credit spreads, and then also kind of looking at that compared to the VIX. High yield credit spreads are actually moving to the upside. VIX is moving lower. That's a correlation that we usually don't see that much. And if you're looking at high yield investment grade credit default swaps, or CDSs, if you will, they've actually been inching up higher over the last, actually since Friday. And that is also something that usually does not correlate with equity markets moving higher. 95% of the time, CDS spreads themselves go lower, equity markets move higher, and vice versa. So we also have a little bit of a disconnect there. Coming back to the fact that the volatility market compared to high yield credit spreads right now is disconnected. Equity markets are looking good. They're rallying, coming up to a potential area of resistance. But I think that you got to be very, very careful here at these particular levels because the dynamics are something that this type of environment, let's say it's a 10% of the time this actually happens and it sustains itself, Caroline. Basically what I'm saying, something actually has to correct. Either yield markets have to correct, CDSs have to correct, or equity markets have to correct.